Hi, this is Fihan. The internet is a wonderful place. In my opinion, the Polish speaking part is great, and thanks to AI, I can bring you some content in a slightly more accessible way. Today, I'd like to recommend a video by Piotr Cymcyk, a Polish YouTuber who focuses on the economy and personal finance. He covers really interesting topics and aims to educate and inform in a clear and accessible way. In the episode I'm highlighting, he talks about stock market crashes and how to prepare for them and get through tough times. Definitely worth a watch.
Stock market crash. Everyone's portfolios are in the red, and the news keeps scaring us. Whether it's a downturn or a recession. And you feel your stomach clench with these declines. You feel like throwing up. From looking at those quotes, you surely know this feeling. Because sooner or later, every investor has to face it.
I have to agree with that statement. For some time now, I've been trying to invest small amounts myself, and I've already experienced a fair share of ups and downs in my portfolio.
The only question is, what do you do then? Do you panic and run counting your losses? Or do you try to guess where the bottom is to buy more cheaply? So, stop. Before you make any decision, listen. Attempts to outsmart the market. In such moments, it's a bit like a walk through a minefield, and most often such a walk through a minefield ends in disaster. So, in this material, I want to show you why it's not worth fighting the market during crashes and major declines. And what you really should do to not only survive such a crash, but maybe even come out of it stronger. Welcome.
Piotr is right here. Outsmarting the market is extremely difficult, if not impossible. Sure, there might be times when we outperform the broader market for a while, but the amount of work needed to analyze what's going on, check all the companies, and track every tiny piece of information that could affect stock prices is massive. And sometimes a single bad decision can wipe out months of hard work.
The partner of this episode is XTB, a Polish brokerage house where you can invest completely commission-free up to even 100,000 euros in monthly turnover. Thanks to XTB, you can also receive a completely free full course for beginners on investing. But more about that will be at the end of this material. Join nearly 2,100 investors in the DNA Premium Zone. It's the best place for investment and financial education, also for you. Thank you for all 66,000 of your subscriptions. Help this channel continue to grow and leave yours now. Crash. You will never be able to predict it, which I explained in a separate material here. A crash unfolds dynamically. A crash has a completely random range, depending on how much financial leverage needs to disappear from the market, and the capital market is a complex system influenced by many, very dynamic factors. Firstly, stock prices reflect not only current data, but also expectations, which dominate the narrative in the short term and can change in a truly unpredictable way. Various indicators may point to potential market overheating, but they do not determine the moment of its collapse. It can be predicted that the market should undergo some correction, as indeed are predictions about the United States at the beginning of 2025, and somehow prepare for it. For this correction, but let's agree, this correction could just as well start only after a further 20% increase. And ultimately, even after the correction, it might end up that we are higher than when we first talked about it. That's why it cannot be perfectly predicted in terms of timing. History shows that most attempts at such timing perfectly fitting into the market end worse than the strategy. Simply long-term saving. Time in the market beats timing the market. Yes, in the long term it was, it is, and it will be. Every investor should come to terms with the fact that their portfolio will, sooner or later, experience some drastic downturn.
In my short experience with the financial markets, I've already seen how a portfolio can swing from plus 10% to minus 10% in just a week. Since my strategy is focused on the long term, it shouldn't be a major issue, so I try to choose stocks carefully and, when things go south, remind myself that things will eventually bounce back. With that mindset, these wild market swings become a bit easier to handle.
By 10%, by 30%, maybe even by 50%. And they should not fight against it. Attempts to oppose the market during periods of intense emotions and high volatility are somewhat like fighting in quicksand. the more you struggle, and the more you try to save yourself, the faster you sink. In the case of investors, this struggle usually manifests in two ways. Firstly, many sell stocks near the bottom, fearing further declines, giving up and somewhat seeking a psychological relief from the stock market. I don't have to look at it anymore. The second group, in turn, starts making chaotic decisions, desperately trying to recover losses by changing the companies in their portfolio, or, for example, betting on further declines when everything is already collapsing. All decisions made under the influence of strong emotions have one effect. It's a straightforward path to nowhere and a direct path to disaster. So how do you survive such a stock market crash? My initial thesis is that the only thing worth doing during such a period, amidst dynamic declines, is simply increasing your market position, if of course someone has any spare funds for it. If there are no spare funds, then do nothing. Why? Well, let me show you. In the years 1996-2015, well, these studies pertain to that period, but there are really many of them, covering different periods. And the effect is the same. The average annual return rate of the average investor was almost 4 times worse than the S&P 500.
It's always good to learn from history, and even better to learn from other people's mistakes. Like I've said before, I don't have a ton of experience with the stock market, but I've already had moments where I watch my investments melt away, minute by minute. Listening to Piotr and other finance-focused YouTubers, one message keeps popping up. In situations like this, you need to know how to stay calm.
What is behind this? Well, according to this study and every other one, it's the attempt to cheat and outsmart the market. And they result, firstly, from the attempt to time the market, which I mentioned. Many investors try to predict when to buy, when to sell, but it most often ends with entering the market too late or exiting it too early. And secondly, emotional investment decisions. Investors very often, almost always, act under the influence of fear, under the influence of greed, selling in panic during downturns and buying at peaks when it rises, instead of simply sticking to a long-term strategy. And all of this generates high fees and commissions. Frequent transactions generate costs that actually reduce your profits. Even if you have reasonable commissions, still. Well, you lose, for example, on taxes. You realize some profit that you've earned, so you're already effectively 19% down.
Was there money? There was. Where is it? I'm asking, where is it?
All the mentioned factors become apparent, especially during periods of heightened volatility. People try to predict how long the crash will last and so on, but they conduct all this analysis under the influence of emotions. After they have already suffered some losses, they start to flounder in the market and make a lot of unnecessary transactions, which only generate more fees for the benefit of the financial market and brokerage houses, but somewhat to their own detriment. However, the worst is the attempt to predict what will happen. All because people really overestimate the significance of recent events and assume that the current crash, above all, will last, maybe not forever, but certainly tomorrow, certainly the day after tomorrow, certainly the day after that. This is the result of the so-called recency effect, which means focusing on the most recent information and assuming that what happened recently is most likely to continue in the near future. And there you go. On one hand, we have a collapsing market, which creates the belief in our minds that the declines will continue. And in the media, nothing else is discussed except the reasons for these declines. And immediately we create in our minds an image of some great apocalypse, a major crisis caused by these reasons, because from every side we are bombarded with information on this very topic. The investor's brain then thinks only about this and somewhat automatically generates a false image of the market, a false image of the economy, a false image of basically everything that's happening, and explains it to themselves by saying it depends on just one factor. For example, recently on Trump's decision about tariffs. It's really damn difficult. But you have to get rid of emotions at this moment, calm down for a while, and think about what is worth doing. Since 1870, the American stock market has experienced 18 bear markets, with declines exceeding 20%, which technically means entering a bear market. The range of declines varied from 20.1% to 80%, with the average for all these bear markets being 35.4%. In April 2025, as I record this, for now, we can only talk about a technical bear market because the decline measured at, after the session closed, it still did not exceed 20%. Only during the day did we fall below 20%. And for the same reason in this comparison that you see in front of you, there are no declines from 2018. There was a very similar setup there as well. But from an investment perspective, let's agree that it doesn't make much difference whether the S&P 500 ultimately fell by 19% or 21%. In any case, it means that statistically most of the decline is already behind the investor since the average is 35. By the way, these calculations also excluded them. All corrections smaller than 20%. And this is quite an arbitrary decision because someone once decided that 20% is the threshold for a bear market. In reality, there is no rational reason to exclude smaller corrections from such calculations. So let's take a broader look. Since 1929, the average range of all corrections is worsened 13.8%. All corrections. So we have long surpassed this average range in the case of April 2nd, 25, which suggests that we have a greater chance to profit if we decide to hold and buy stocks rather than sell them. Or worse, short them, betting on declines. At such a moment in the market. And I'm getting to the point that since statistically during the course of a crash we are closer to the bottom. So fleeing the market is statistically unprofitable. And yes, surely someone among you will soon say and write, but it might drop by 50%. Sure? It might drop by 50%, it might drop by 90%, but making decisions based on might doesn't make sense. And maybe it will rise by 50%. But such ideas that it might rise by 50% don't come to mind, because we return to the recency effect. After all, everything is collapsing. It will surely continue to collapse. You can't invest in stocks without experience. Capital drawdowns. There was even a study conducted once which examined what an investment strategy based on perfect foresight of stock market outcomes would look like. The researchers assumed that an investor could look into the future and every 5 years select 10% of all companies with the highest future returns after those 5 years from the S&P 500 index. Thanks to this ability to look into the future, this portfolio would generate an average annual return of nearly 30%. In comparison to the less than 10% achieved during the same period by the S&P 500, and it would generate these 30% for 100 years. For 100 years, 30% every year. However, even despite fantastic choices and excellent stock selection, this portfolio would also experience multiple capital drawdowns of 20, 30, 40%, and once it even experienced a drawdown of 70%. So even if you choose only companies that turn out to be the best in the world and allow you to earn annually on average 30%, you still won't avoid volatility. You still won't avoid the volatility resulting from the characteristics of the entire broad market. And despite this, despite these crashes and drawdowns, the average annual return from this portfolio would be almost 30%. And why? Well, because ultimately the market grows longer and stronger than it falls. Is that all? And that's quite a lot. This is the only mantra you need to drill into your head. The market grows longer and more. Then it falls in the long term. Declines always have limited potential, unlike growth.
This is a bit of a longer segment, but I think it's really worth listening to without interruptions, at least in my opinion. The market tends to go up more often and for longer than it goes down, and beating it consistently, that's incredibly hard. That's basically the core of my strategy, if I can even call it a strategy. And yeah, I get it. This approach isn't for everyone. Some people are willing to take on more risk, invest more time, and that's totally fine. But I do think it's smart to have at least part of your portfolio that moves in sync with the market.
The average increase in stocks during a bull market in the United States since 1933 is about 170%. That's why it's more beneficial for you to endure a crash than to simply fight against it. And I have another great statistic for you. Trading strategies. In the long term, they almost always lose to the simple buy and hold approach. Of course, we are talking here about an index investor, not an investor in specific stocks. The study was conducted by the Money Institute. For a selected broad period, the buy and hold strategy on the S&P 500 index provided the investor with an annualized average annual return of 6.4%. But there were also alternatives. The alternative strategies were as follows, where someone buys the index only after a certain drop from the peak, which is the axis on the left that you see, and then sells when they earn X%. That's the axis on the top. For example, I always buy the index when it drops by 20% and take profits when I earn 100%. And then I wait again until it drops 20% and so on. Such a strategy provided an average annual return, as you can see, at about 5.2%. So in total, less than just buying and waiting. In fact, none of these trading strategies of waiting for a drop and then catching the bottom and escaping after a profit, X%. which is the domain of trading strategies, yielded better results than simply buying. And waiting, because that's the magic of compound interest in practice. However, if we only use the market drop to increase the overall position and then once again simply wait, then our result will be much better than the 6.4% from this study. To avoid succumbing to additional emotions, you just need to become an increasingly aware investor. Declines, especially those exceeding 15-20%, are moments that, at the right time, allow an investor to outperform the broad market, provided that they make good use of these declines. And now I will show you another interesting statistic. The table you see shows how the S&P 500 index behaved every time it dropped for 2 consecutive days, by more than 4.5%, just like recently on Thursday and Friday, the 3rd and 4th of April. Such situations occurred rarely. And the market always had some reasons for concern then. And yet, in 80% of cases, 12 months after such a downturn, the market was already significantly higher, and it delivered an average return rate of 15.8%. And what if now it will be that 20% and it falls? Okay, sure, that's possible. But still, the scale of the potential drop is already small. Once, in the following months, it fell a total of another 2% and once by 7%. In reality, this only meant more time to accumulate stocks at low prices. Market panic. It has the characteristic that it cannot last forever. Investors can be extremely fearful only for a moment, and at some point, greed always prevails. And this greed can persist for a significantly longer time. If despite this you have some problem controlling your emotions, just disconnect from the market for a while. I hope you didn't start investing with a monthly horizon.
This is another point I completely agree with. To be honest, I'm investing with the long game in mind. 20, 30, maybe even 40 years from now. To have that extra capital built up slowly, carefully, and through well-thought-out decisions. And yeah, I get that the stock market also attracts people who are looking for that one golden shot to get rich quick. But honestly, I think even those folks can learn a lot from what Piotr says, if they're willing to listen.
Peter Lynch, one of my favorite investors, made it clear.
Another thing, if the money goes from 10 to 6, if you understand what they are doing and know that they are financially complex, that's fine. If you don't understand, you might call it a mental occupation. But if you don't understand, you'll probably make something slightly wrong.
This is why index versus stock investing is so different. Investing in stocks. Are you investing in an index? Just buy. Are you investing in individual stocks? As long as you understand your investments and what these companies are doing, it will be okay. So remind yourself why you have something in your portfolio. Consider to what extent your potential thesis is at risk. Are you sure you want to get rid of businesses you consider good right now at unattractive prices? Well, for example, I don't want to, and I definitely prefer to be on the buying side then. And for buying and investing, not only at the start, but also for experienced investors, a good account is especially useful. Ideally one where there are no commissions, and at XTB you won't pay commissions, so at least the cost of your strategic juggling will decrease, because there are no commissions up to 100,000 euros of monthly turnover. And in addition, if during the account setup you use the DNA Rinkov code, which is now visible on the screen, and where to enter it, you will gain access to specially prepared materials for beginner investors, through which you will learn how to best start your investment journey. Maybe then you'll make a few less mistakes at the start. And if you want to be additionally more up to date with the market situation, the economic situation, and the situation in various companies. And here, remember to also check out the premium version of the DNA portal, where you can join almost 2,100 investors who receive various analyses and insights about markets, the economy, and companies almost daily from me and my entire team. Additionally, they have the opportunity to observe how I personally invest my own savings in portfolios with a total value of over 3.5 million PLN. So there's a lot of money, a lot of emotions, but I guarantee there's even more. Learning. And you can find more about this on the website premiumdenarinkov.pl. The link is of course in the description of this recording. And that's all for this material. To making profits. Bye.
At the end of this video, I've included a short promo for Piotr's channel. You'll also find links in the description, both to his channel and to the original video I talked about here. Definitely worth checking out. From my side, I just want to say this. The stock market really can be a solid way to take care of your financial future. With the right plan and smart decisions, it's even possible to soften the impact of inflation a bit. That's why I can wholeheartedly recommend Piotr's channel to anyone curious about the world of finance. In the future, I'll try to introduce some other creators covering similar topics, and I'll definitely share more of Piotr's content too. That's it for today's video. I hope that over time I'll be able to bring you even more content like this, or maybe something even more interesting. As always, all the links to the original video and the creator's channel are down in the description. Take care and see you next time.